Well, hello, everyone. Cynthia Tomaine with Interactive Brokers, and thank you for joining us this afternoon as we take a look at dynamic management of volatility as an asset class. I'm very pleased to have Taylor Lukoff with us today, but what I'm going to do is pass this information or pass the ball over to my colleague, Willie Katz, to give you a brief introduction on Taylor and ABR dynamic funds. Willie, it falls in your court.
Thank you. Can you hear me, Cynthia?
I can hear you just fine.
Excellent. So we're very privileged today to have Taylor Lukoff from ABR Management, LLC, and its subsidiary, ABR Dynamic Funds. So it took me about 6 months to convince Taylor to do a presentation like this. I met with his team on several occasions, and I'm really impressed with ABR. A little background on ABR is they're a quantitative research and development firm that have a focus on volatility. He has an impressive team that consists of quants and portfolio managers with backgrounds in physics and engineering, some who attended the likes of MIT, Columbia, and one of the top technical universities in China. This group has a wealth of knowledge that starting out as a derivatives traders on the American Stock Exchange to some of the most prominent trading desks on the street. Suffice to say, we're speaking with people who understand volatility over an extended period of time in practice as well as theory. And they've been very successful at it. So we're extremely excited to have Taylor Lukoff, who's the founder of ABR, with us today. And Taylor, I'd like to welcome you from IB and some of our clients.
Thank you, Willie. Can you hear me okay?
I hear you fine.
Great. And welcome, everybody. Thank you for that wonderful introduction, Willie. And, you know, it took you 6 months to get us here, but we're very happy that we're here, and we're excited to explain what smart volatility is. So if you give me 1 second. So we began our careers on the floors of various trading exchanges. We were floor market makers and floor specialists in volatility trading. And our background with over 50 years collectively in volatility trading led us to a very successful run in the 2008-2009 financial crisis. We traded volatility, and that's one of the few things that actually worked in this time. But a lot of people that we saw may not have done as well during this crisis. So we have endeavored to build a firm that brings strategies that were successful for us to everyone else in the financial community. So we're here today to talk about smart volatility and volatility as an asset class. But first, we're going to paint a picture of what's going on in the marketplace real quick, and then move along to what volatility is and how it can be employed in your clients' portfolios. So first of all, we believe there's a major crisis on the horizon, and we don't know when or we don't know how it will occur. But this crisis is may be different than what's happened historically. So traditionally, advisors have had their clients' portfolios in something like a 60-40 equity to bond ratio, and or something close to that. And typically, those bonds protect the equities in a crisis, and the equities obviously outperform bonds in a bull market. The current situation has 60-40 portfolios in a little bit of trouble, potentially, as stocks and bonds are near all-time highs. We believe that portfolios need a new diversification tool, and this diversification tool is volatility as an asset class. So before we get too far into smart volatility, we have to discuss a typical portfolio that has used static allocations of volatility. I'm sure some of you are familiar with the VXX, ETN, and the VIX itself, which we'll explain in more detail. But a static allocation to these products, to volatility, has potential to be problematic. ABR has developed a model-driven, dynamically managed volatility method called smart volatility. Before we get into that, let's talk about what the markets look like over the past 100 or so years. So in the past 90 years, the S&P spent about 25% of its time in a bear market. And there was a drawdown of over 80% back in the 20s and 30s, and more recently we saw drawdowns in the financial crisis of over 50%. We believe that crises occur more often than people think, and depending on how you look at what a crisis is, we think they happen around every 5 to 7 years. So just in the last couple decades alone, you saw the Russian financial crisis, the credit crisis, the U.S. Treasury flash crash, the Greek crisis in late 2011. So these crises happen more than people think. So what's different this time in the lead up to whatever's going to happen next? Well, current Federal Reserve policy has interest rates at record lows, and the yields in U.S. Treasuries, and we'll show you a slide on this, are the lowest they've been in almost 140 years. When money is cheap from the government, it can cause corporations to borrow. What do corporations do with this cheap money? They turn around and buy their own stock through stock market buybacks. So this leads to higher priced stocks. So you have a situation that's unprecedented where the Federal Reserve is loaning out money cheaply, which causes yields to be extremely low. And at the same time, corporations are using this money to buy their own stocks, driving equity prices high. Right here you can see in a chart that goes back all the way to 1876, U.S. Treasury yields are at or near all-time lows. When you look at stocks, using something like the PE ratio, which is the price to earnings, and that's a measure of how expensive stocks are, relatively speaking, we're currently in the 90th percentile. If the median is down here, we're all the way up in the 90th percentile for how expensive stocks are. So we're in a situation that's unprecedented, again, with stocks and bonds at all-time highs. What we're also experiencing is stocks and bonds moving in tandem. This usually doesn't happen. Usually when stocks go up, bonds are flat or down, or when bonds are up, stocks are flat or down. This is a very unique scenario of the last 10 years. So if stocks and bonds have risen in tandem, it follows that it is possible for them to fall in tandem. Now, we're not here to predict when the next crisis is or if it will occur or what will happen, but certainly one can think that this may be a different situation. And with rates at nearly zero, the Federal Reserve doesn't necessarily have as much ammunition for the next time. So let's look at different asset classes and how they relate to each other and how they related to each other in the last financial crisis to talk about what might happen next time. So in the 2008-2009 crisis, equities, which are all the way down here, real estate, commodities, all experienced drawdowns over 50%. Bonds, which were supposed to protect portfolios, were flat to up maybe 3 or 4%. So you really didn't have any protection in a client portfolio during this crisis from bonds. They didn't lose money, but they really didn't make much money. And this slide shows how large those drawdowns were. And if you had a typical 60-40 equity and bond portfolio, you saw drawdowns around 25%. Alternative assets, like commodities and real estate, also experienced large drawdowns. So what is an advisor to do for the next crisis? Well, we believe that instruments that look at volatility as an asset class may be the solution. So let's look at a slide that overlays volatility on top of the 2008-2009 financial crisis. As you can see, short-term volatility gained approximately 341% at its peak in the financial crisis. This is the only asset class of the 6 on this chart that's going to provide a meaningful outperformance that adds positive return in the prior financial crisis. So now we understand that volatility could potentially be that asset class that's missing in a client portfolio. Let's talk about how volatility works. So volatility over time has tended to have a very high decay rate. So you're buying premiums, waiting for something bad to happen, and of course you're paying for those premiums. Those premiums decay while you're waiting for that bear market or crisis. The seller of those premiums does very well for an extended period of time. Of course, they run into trouble when the crisis happens, but they're generally okay collecting those premiums. So we keep talking about volatility as an asset class, and I mentioned earlier the VIX. So what is volatility? How is it expressed in indexes or tradable instruments? So the VIX index, I'm sure many of you have heard of. The VIX is a reflection of the volatility of the S&P 500. VIX index futures are liquid instruments based on the VIX index. And based off of those VIX index futures, we now have something called VXX, which came about in February 2009. And this was based on VIX index futures and provides something that's like an ETF. It's actually called an exchange-traded note. And this tracks an index with the ticker SPVXSTR. Now, you don't have to remember that ticker, but the purpose of this slide is for all of you to understand that the VIX reflects the volatility of the S&P 500. VIX index futures are a tradable instrument. VXX is an exchange-listed instrument. And that ticker, that SPVXSTR down here, is what you want to think of through the rest of the presentation as volatility for the client. And by the way, feel free to ask questions through the chat window at any time. We will stop at the end most certainly for questions, and we can answer them throughout the presentation. So let's take a look at the VIX index versus the S&P 500. This is a chart from 2006 all the way up to 2016, and you'll see that the S&P 500, when it has dipped over time, generally the VIX has spiked in the past. So this is 2008, 2009. This is the flash crash right here. In late 2011, you have the Greek credit crisis, and then, of course, in August 2015, you recently had a spike in the VIX as well. So when the S&P dropped over the past 10 years, the VIX has generally spiked. So what this means is that volatility is a negatively correlated asset class. So what does negative correlation mean? Negative correlation means as one product or asset goes higher, the other product or asset goes lower, and vice versa. If the other one drops, then the negatively correlated asset class increases. So this is a look at all of the asset classes we mentioned earlier, and when looking at these asset classes over the past 10 years, commodities, real estate, currencies have a positive correlation in the S&P 500. The only two asset classes over time that have a negative correlation to the S&P over the past decade have been fixed income and volatility. So you would think that if you want a way to hedge your client's portfolio, you could buy fixed income or volatility. Well, let's take a look at how this worked in the 2008-2009 crisis. In the 2009 crisis, we saw commodities, real estate, and currencies have positive correlations. Fixed income, which was supposed to help protect, actually gained correlation. The only problem, the only instrument that gained a negative correlation, retained a negative correlation and actually became more negatively correlated was volatility. So it follows that this is the asset class that you should use if you want to protect clients possibly in a future crisis. Fixed income is not going to help too much, and the other asset classes aren't going to help. So I see some questions about ETFs and ETNs that track the VIX, and There are current strategies or indexes that do track volatility as an asset class. We call these static volatility strategies, and they have several problems. If you buy volatility, so I just presented you with the only asset class we believe that will outperform positively in a crisis. So why not just buy volatility for your client? Well, here's the problem. If you buy and hold it, you will bleed out over time, and we'll explain why. So then you might think, great, why don't I just sell it if it's going to go to zero over time? Well, then I'll blow out in a crisis. And that's even if I'm going to use an inverse ETF, which I also see are being discussed in the chat window. Okay, so then why don't I buy low and sell high? Well, that's going to be the worst of both worlds. You'll bleed out and blow out for your clients. So let's take a look at what's wrong with current static volatility strategies. First, the bleed out. So the index we talked about earlier, SPV XSTR, has tended to decline dramatically over extended periods of time. Our portfolio manager, David Skordal, wrote a paper that discusses this bleed out called Smart Volatility, Dynamic Management of Volatility as an Asset Class. He's identified an average drop of 1% in value every 8 trading days for this index. That's the premium payments that we discussed earlier. So why not sell it and wait for it to go to zero? Well, the problem is, during the 2008 crisis, you will blow out and lose all of your money if you put this strategy on. Anytime you see a massive spike in the VIX, you may lose all of your money. So that's not going to work. Okay, so why not buy an inverse ETF? Well, you will blow out again. This is an inverse index of the SPV XSTR. And this strategy in that same period, in the fall of 08, early 09, had a 92% drawdown. So buying an inverse isn't going to work either. Okay, so why not buy low, sell high? Well, we call that a wild ride to zero, a long wild ride to zero. So you start with $100. You're not going to do very well in 08, 09 because of the reasons we just mentioned. And then in an extended bull market, which we've experienced over the last 5 years, you've slowly bled out. So that strategy historically has not worked either. There's a 97% drawdown by 2015. So how should you manage volatility? Well, we believe smart volatility is a solution. Portfolio managers and their clients, or financial advisors and their clients, need a systematic method of dynamic rebalancing of volatility in a portfolio. And what we've created strives to both capture spikes in volatility and avoid the decay of the premiums that are inherent in volatility management. Now I'm going to explain how those work. So this is a very simplified chart of smart volatility. In a bull market, you want to be, it is long equity with a little bit of volatility exposure. And in a bear market, it's long less equity with a greater volatility exposure. It seems to make sense. That seems simple. And I think advisors want this. But they might have been trying to do this over the past 5 or 10 years, and it hasn't worked out so well with all of the head fakes in the market, particularly in the last 6 to 8 months. So how does this work? The short answer is momentum. And most of you have heard of momentum in equities, futures, other asset classes. We believe that we have an inherent edge in our ability to trade volatility using momentum signals. So there's some big words here like autocorrelation, implied volatility, realized volatility. We're going to break it down into 4 very simple phrases. The first one is buy high, sell low. This is counterintuitive, and we'll explain why it may work. The second one is the trend is your friend. I'm sure everybody's heard that on CNBC before. The third is something doesn't smell right, and I know that sounds interesting, and that does discuss the term structure, and I've noticed some discussion of contango versus backwardation in the chat box, and we'll get to this. And then the fourth is fear is contagious. Fear begets more fear. So the first signal is buy high, sell low. Sounds counterintuitive. Well, in our discussion of dynamic management of volatility as an asset class in our white paper, we've shown that over the last decade, if the VIX is 30 or higher, which only happened about 12% of the time, the next day average return of volatility is about 0.1%. If it's below 30, the next day return of volatility has been about negative 0.16%. So what does this mean? This means that if volatility is over 30, I want to own it. And if volatility is below 30, I probably don't. Now, how ABR uses these signals in our smart volatility products is our own proprietary rebalance. We don't think that you should just buy volatility when it's over 30 and just sell it under 30. There's certain places in there where you want to accumulate more and less, and that's a little bit of our proprietary trading methods. So let's look at our second signal, the trend is your friend. So I'm going to first go through this little decision tree and then get back to the statement that's above it about volatility moving in the same direction. So we looked at realized volatility over the S&P 500 over the last decade. And if realized volatility, if how much the market actually moved, went up today on day one, 53% of the time it went up on day two. Okay, so the market moves a lot and realized volatility goes higher. 53% of the time it goes higher the following day. If it went down today, 54% of the time it went down the next day. So what we've shown here is over the last decade, the trend has been your friend. Volatility has moved in the same direction 54% of the time over the last decade from the previous day. So if it's going up, it has a higher than a coin flip's probability to go up, and same on the way down. That's very significant. Signal number 3, something doesn't smell right. So what does this mean? Well, here's where we have the discussion of the term structure of volatility. So we're looking at short-term volatility and versus mid-term volatility. And when these ratios are off over the last decade, there may have been a opportunity to buy volatility. So if the ratio of short-term to mid-term volatility is above 1, which happened was above 1, about 15% of the trading days in the last decade, the average daily return of volatility is positive 0.36%. So that's a signal that we also get, and it's not as simple as what's on the screen, obviously, but you can see that the relationship to short-term and mid-term implied volatility can give you a signal. Our fourth signal is fear is contagious. Now, this is something that you might have heard a lot, but what we're looking at is what happens when the VIX is over 30. Sorry, the realized volatility is over 30. Well, this happens about 10% of the time over the last decade, and the average daily return has been positive 0.37%. So fear is contagious. As things are getting crazy in the marketplace, they tend to get more crazy. So these are our 4 signals that we're using to develop a proprietary system that allows us to manage volatility in a dynamic manner. So we're moving in and out of volatility depending on what these signals give us. And we think clients and investors can do this through a static allocation to products like smart volatility. So our key takeaways, and then I want to get into some Q&A. There have been times of crisis in the past, and there'll be times of crisis in the future. We tend to think it happens a little bit more than people expect, and a little more often, I should say. And this time might be a little bit different. And when these crises happen, you haven't been able to just buy a static allocation to long volatility. You can either blow out or bleed out, pick your poison. We believe that the system should be completely rules-based. We believe you need to remove the human elements of fear and greed from the decision-making process and provide a static allocation to a dynamic strategy. Advisors don't try and time equity markets or time bond markets in general. They shouldn't be trying to time volatility either. We believe we're providing them with the solution. And this is smart volatility. So the conclusion is advisors need volatility as an asset class. This time might be different. The 60-40 stock-to-bond portfolio could experience serious drawdowns if interest rates start rising at the same time that equities start falling. Research, as we've shown, indicates volatility shouldn't be held in a static allocation. And we're happy to offer smart volatility. ABR, besides our volatility trading, builds other systematic quantitative investment strategies. You can learn more about us at abrfunds.com. Again, my name is Taylor Lukoff. I'm the founder and CEO of ABR Dynamic Funds. And if you're interested in our white papers, past performance, the fund itself, you can learn more at www.volfunds.com. And now we will take any questions that you want to type down in the chat window. I do want to respond to, I guess, we had a question from Vivek. Is realized volatility computed using daily close-to-close returns or using intraday returns? Well, we're using close-to-close returns in our research. So we're looking at the close each day, and that's a very good question. There are intraday returns, obviously, and there are other strategies that you could create based on them. So our next question comes from Nicholas. What products will the mutual funds be allowed to trade? That's a great question. So the mutual fund is, if you read our prospectus, the mutual fund is allowed to trade many products. The mutual fund generally seeks to hold allocations in the same proportion as the underlying index, which is ticker ABRVXX. The products can be futures, ETFs, ETNs, and generally we look to hold futures. Next question comes from Brent. Is your focus solely on the SPX, or do you look at other volatility indices as well? That's a great question, Brent. We look at several volatility indices. There's the V stocks, which is published by Eurex. There's the VIX. There's short-term VIX, mid-term VIX. There's volatility indexes on certain sectors now, such as gold, oil, treasuries. We look at volatility in pretty much every asset class we can. For the focus of this presentation, obviously, we've been talking about the SPX. The VIX and the VIX futures are the most liquid, heavily traded volatility products in the entire world. We look forward to both the CBOE and other exchanges to continue to roll out more and more volatility products going forward. So our next question comes from William. How does this strategy perform over an extended up market? Well, if we go back to this slide right here, how does smart volatility work? Now, this looks very simple. In an up market, we want to be long more equities, right? Over an extended bull market, the strategy can have up to a 100% exposure to equities. So when you don't have any of these four principles, so let's go through these principles. When you don't have any signals, such as buy high, sell low, if volatility is low, we're not going to be buying it. If it's not trending higher, we're not going to be buying it. If the relationship between the near-term and mid-term VIX is not off, doesn't smell right. If it does smell right, we're not going to buy volatility. And if we're not seeing any fear in the market, we're not going to be buying it either. So in an extended up market, we would expect to have positive returns with a small lag to the S&P 500 that hopefully wouldn't be meaningful to an advisor in their portfolio, as this is an alternative asset. So overall, we're hoping that the strategy has we seek to have a positive return with a lag to the S&P 500 in a bull market, an outperformance of the S&P 500 in a bear market, and positive absolute returns in an extended period of crisis. That's what we are targeting with this strategy. So the next question is from AJ. What is the difference between short-term and mid-term volatility? So I think what you're getting at, AJ, is what are we looking at for our short-term volatility index, and what are we looking at for our mid-term volatility index? The short-term volatility index is generally 1 month of volatility. Our mid-term is generally the 3-month volatility. So we're looking at 1 to 3 months in that volatility curve to derive our ratio for that signal number 3, something doesn't smell right, which is this one right here, the short-term and mid-term. It's a great question. So our next question is from Bill. Do you expect an increase in volatility going into the election cycle, and how will the strategy perform in that increased volatility environment? Well, we don't like to have opinions on the market direction or volatility. Our job is to prepare systematic, quantitative strategies that will operate independent of anyone's personal view. You know, you might see increased volatility in the election cycle. Generally, traders are smart enough to price that in. We will be looking at the realized volatility just as much as the implied volatility going into the election cycle in our strategies. And, you know, if there is extended periods of volatility, and I'm not talking about 1 day of the election, but an extended period, we hope that the strategy will outperform the S&P 500 in that environment. So our next question comes from David. Do you look at IV, and he means, I believe, implied volatility percentile, which is where an underlying's implied volatility is relative to its own history. For example, if it is the 90 percentile, its options would be priced higher than 90% of its history. Choose your time frame to look back. So are we looking at where implied volatility is relative to its own history? We're looking at where it is relative to its own history. That's a great question. So I think that's getting a little bit into our proprietary algorithm, but we are developing models based on where implied volatility has been historically and where it is now, and that then pulls out some of the signals from these 4 signals that we've shown you. The next question is from Scott. Can you please show an equity curve of this strategy combined with a 60-40 portfolio? Scott, I'm more than happy to show you something. We can talk offline, and I'll get your information. And if you think about it, so that kind of gets to a better question, which is how would an advisor use this in their portfolio? We get this question all the time. We believe volatility as an asset class should be about 10% of a client portfolio, and that might involve selling covered calls, buying or selling puts, depending on how you want to play it. We believe this strategy should be somewhere between 5 and 10% of a portfolio. And we do have charts and graphs that show how we've performed over time since we have launched in August as part of a 60-40 solution. I believe that we are within a couple percent of the S&P 500 since we launched, with about half the standard deviation of the S&P 500, which is very important. So from Vivek, do any of your, and thank you for the follow-up question, do any of your strategies trade VIX or VXX options? And he correctly identified an alternative to buying VIX futures is buying VIX calls. Our strategies at our firm do involve options. For this particular strategy, we do not use options. It's important to note that when you introduce options on the VIX, you're dealing with the volatility of volatility. And that in and of itself introduces a whole new element to the discussion and how you're looking at volatility as an asset class. From Lev, do you have a mathematician in your team? That's a great question. So on our team, we have a physicist from MIT. We have a mechanical engineer with a master's degree as well from MIT. We have somebody from Columbia's prestigious operations research team. All of these individuals are highly skilled in mathematics. We do not have a PhD in mathematics on our team. I don't think that that puts us at any advantage or disadvantage. As far as our positioning, there's a question about, do you still use volatility as a black swan hedge during up markets? This strategy is not intended to make to have positive returns on any given day when volatility occurs out of thin air. So, for instance, the VIX is at 10 or 12, or even where it is today, around 14.5, and all of a sudden you see volatility spike due to, let's say, an exogenous shock, an airplane crash, or an assassination, or some other geopolitical event. This strategy may not be effective and probably will not be effective. Now, if that exogenous shock is truly exogenous, the market will turn and rally, and our strategy will be fine. If it becomes something systemic, this strategy will start to roll into more volatility. And as we've shown, volatility may beget more volatility, et cetera, et cetera. But if you're looking for something that is a black swan hedge today where the VIX is, this is not the right product for you for a short-term hedge. If you want to be long volatility, you can buy the VIX, you can buy VXX, et cetera. This is not intended to replace that. Instead, this is intended to be a long-term hold that's a static allocation within your portfolio, so you're not trying to guess when a black swan may happen. And a black swan event generally is an extended period of time. Very rarely do you see the markets drop more than 10% and out of thin air with no kind of increased preceding volatility. This generally, we can't find any examples of it where that happens and then we don't have an extended period of volatility following that initial drop. And that's where the strategy can really provide the outsized returns. Do we have any other questions? Willie or Cynthia, do you have any other questions or any other discussion items you would like to go over?
Well, what I will do right now, by the way, thank you very much, Taylor. I do have one piece of business, so if you do have any other questions, now's the time to go ahead and enter those into the chat panel. But while we're waiting for additional questions, notice what I'm going to do. I have a short poll that management requires in each of these sessions. I'm going to open it up on your screen, and you'll notice there are 3 short questions there. I do ask that you take just a moment and respond. Now, you'll notice 2 of those questions are multiple choice. So we do try and keep this rather quick so we can get back to any of your questions. Notice once you make your selection, there's a submit button in the lower right-hand corner of the screen. Using that button will allow me to compile those results. Poll is only open another 4 seconds, so please finish up and make sure that you do click that submit button. Thanks, everyone. Poll did end, and I do appreciate the feedback. I'd like to turn this back over. By the way, if you've closed your chat panel, or if the chat panel is not visible, notice you can simply double-click the title bar that's available over on the right and open that chat panel up again. Looks like I think we may have just gotten another question in there, so I'm going to let Taylor finish up here today.
Great. So thanks, Scott, for giving us one more question. Have you tested this strategy in volatility outside of the S&P? Meaning, might it work in, say, Treasury volatility, gold volatility, et cetera? We have tested it. Those tests are ongoing. We have several more products and indexes that will be coming out over the next 6 to 18 months. So you can look for them. I would say that even though the strategies might work in some of these other asset classes, as I mentioned earlier, it's very difficult to find scalability in a VIX for the treasuries or gold. They do exist, by the way. These futures do exist. They're not very well traded, and we're typically looking for products that have scale of at least 1 billion US. So that's a great question. And you can find this strategy, by the way. The ticker is, we just had a question come in, a private question. The ticker for the strategy is ABRVX, Alpha Bravo Romeo Victor X-Ray, on Interactive Brokers. And we're happy to have any further discussions you'd like on kind of how that performs over time and how smart volatility works. And this is available for retail traders. The retail ticker is ABRTX. That's Alpha Bravo Romeo Tom X-Ray, ABRTX. So both of those are available through Interactive Brokers. You can contact us, Willie, or anybody on the Interactive Brokers team for more information. With that, I'll turn it over to Willie and Cynthia to wrap things up.
All right. Thank you very much, Taylor. That was pretty informative. And like you said, you have Taylor's contacts on the PDF. Take a look at it. If you have any further questions, you can reach out to me. Have a great day.
Well, thank you, everyone, for joining, and a great deal of thanks to Taylor Lukoff for making today's event possible. Now, I do want to remind everyone, as you do exit our session, be on the lookout for a PDF copy of today's presentation to pop up in a new browser window. You can bookmark it or simply download and print directly from there. By the way, we have been recording today's session, and we'll be sending out a direct link so that you can come back and review any of the concepts that Taylor did go through today whenever it's convenient for you. So with that, we are going to conclude our event today. You can exit using the X up in the upper right-hand corner of the screen. Thanks for your time. We appreciate the time you spent with us here this afternoon. Have a great day, everyone. And remember, all to trade smart. Thanks, everybody.